Howdy, Jacob here. Today we're looking at Axon Enterprise, company 73 of our generic stock screener in the aerospace and defense industry. So basically, they sell a lot of equipment that policemen wear. And so I do think that they have definitely a selling advantage. I don't want to say monopoly. I feel like that gets a little, harsh sometimes, but Opoly something. They definitely have an advantage in that type of field where they manufacture, sell, conduct CEDs, tasers to a lot of police forces and everything, pretty much um, around the states, internationally and such. But it's super high valuation with that super big growth rate. I mean, this is humongous growth. You have compound annual growth rate in the 20%, and it's actually surprising that it's growing more. So you see 19%, 20%, in the most recent years, 27%, 38%, 31%. So they have immense growth rate. I do wonder where it's going to plateau. There is going to be a point where everyone in the police force has their products. There's not going to be much growth beyond that. But where is that? I don't know without doing further analysis. But um, again, this initial analysis will just be based on the numbers. We do see operating margin down quite a bit from the high teens to high single digits. Gross margin is relatively the same. Return on invested capital down from mid teens to high single digits. And let's see, so a little bit of huge R&D growth. So that's what's hitting a lot of that operating side, but still, that basically is investing into your future self. So you're taking money away today to hopefully get more money in the future. So we'll see whether those are good investments or not. But I mean, to be investing you're investing 20 times what you were 10 years ago in research and development. I mean, that's pretty positive. Cash balance sheet shows 599, 1.3 million roughly in cash-like products, 677 million short, long-term debt. So more cash than the debt. Write it off. No worries. Balance sheet, definitely no problem there. Good reinvestment back into themselves, but they are issuing quite a bit of shares both through stock-based compensation as well as funding other projects. Um, so you're going to have to keep that in mind. I mean, this isn't really the best. It's tough to view companies with this type of capital allocation because all we see is a little bit of acquisition, quite a bit of reinvestment, issuing shares, issuing debt. I mean, throughout a 10-year period, I definitely would have thought I'd see, some more share repurchases, some more debt reduction, but here I'm just not seeing it. So it's very interesting that they're very heavily reinvesting back in themselves, which again can be positive. That's basically taken away from now to get to future growth. But yeah, so that's pretty interesting, and also interesting. The free cash flow is fairly positive, but it's also through issuing quite a bit of shares. So keep that in mind as well. So let's start making some assumptions here on the revenue growth side. I mean, do we think, 15% a year for the next 7 years, does that seem conservative? Possibly. 25 PE, is that low? Maybe. It could be low. I don't know. I don't necessarily know where the end of this is, so maybe I'll do higher. Maybe because I want to do more research on it, I'll put it a bit higher than where I think realistically it should be. But if we do somewhat of a range here, maybe 8 to 10, and then for share change, they're a $20 billion corporation, 170, let's say 200. They increase it 1%. Okay. I mean, this is saying that the company needs to fall 81% to get the return we're looking for. I mean, really no surprise there. Current P of 82, we're saying down to 30 with revenue growth equaling our discount rate. It looks like a fantastic company, wonderful business. I would need to do more research on this to to make sure that they could grow their revenue as much as they have in the past. I mean, even at 25%, you're still looking at 67% undervalued. It needs to fall 67% to get to the number we were looking for here. And so, do I think that's a lot? Yeah. I mean, maybe 20% I'd be more comfortable with. But even still, it has to fall 75%. So maybe I'll stick with this because I want to do more research on it sooner. But I mean, 75% drop is a pretty significant number. Company I want to own? Absolutely. But every investment is present value, future cash flow. Not everyone, but most investments are present value, future cash flow, and earnings. And here, I think you're buying it for a very expensive price. I think that the growth is absolutely going to be there, but I think you have to balance out the realistic outcome of the goal of their revenue growth with their current valuation. So hopefully you enjoy the video of the rest of your day.